number that prices nearly every commercial building on the planet. Office towers, warehouses, apartment complexes, strip malls, all of them. It is called the cap rate. And once you understand it, you can look at almost any deal and instantly know two things: what it is worth and how much risk you are being paid to take. Most investors fumble it. They chase the big number and get burned. So in the next few minutes, I am going to make cap rates click for you. The formula, what counts as good in 2026, and the one trap that fools beginners every single time. Let's go. Here is why this matters. Whether you are buying a single drive-through or a 400-unit apartment community, the cap rate is how the deal gets priced. It is the common language of the entire industry. Brokers quote it, lenders watch it, appraisers live by it. Get comfortable with it, and you can compare a warehouse in Orlando to a medical office in Tampa on the exact same scale. Misread it, and you will overpay, or walk away from a great deal because you did not understand what the number was telling you. So let's break it down piece by piece. Start with the simplest definition. A cap rate is the annual return you would earn if you bought the property with all cash, no loan at all. That is it. It is the unlevered yield of the building itself. A 6% cap rate means the property throws off 6% of its price in income every year before any financing. Because it ignores your mortgage completely, it is a clean, apples to apples way to size up any deal. Think of it as a speed read on both price and risk in a single number. Now the formula. And there are really just two. First, cap rate equals net operating income divided by price. NOI is simply your income after operating expenses, but before your loan payment. So a building that nets $100,000 a year and sells for $1.67 million is trading at a 6% cap. Flip that same equation around and you can price any deal. Value equals NOI divided by the cap rate. Take that same 100,000 in income, divide by 0.06, and you get a value of about $1.67 million. Income divided by cap rate equals value. Master those two lines, and you can underwrite on the back of a napkin. So what is a good cap rate? Here's the truth. Nobody tells beginners. There is no single answer. It depends entirely on the asset class. In 2026, the safest, most in-demand property types trade at the tightest caps. Class A multifamily and modern industrial sit roughly in the low 5 to mid 6% range. Triple net retail with strong tenants runs about 5 to 7%. Then it widens. Strip centers push into the high 6s and 7s. And office, especially older value-add product, can run 7.5 to well over 10%. A lower cap is not better, and a higher cap is not better. Each one is the market pricing the risk of that specific asset. Next, why do cap rates move? Three big forces. 1. Interest rates. Cap rates track the 10-year treasury plus a risk premium, so when rates climb, caps climb with them. 2. Risk. Shaky tenant credit, a short lease, a tough location, all of it pushes the cap rate up because buyers demand more yield to take on more risk. 3. Growth. Strong population and rent growth pull caps down because investors will accept less yield today for more upside tomorrow. And here is the part that trips everyone up. Price moves inverse to the cap rate. When cap rates fall, prices rise. When cap rates rise, prices fall. Same income, lower cap, higher price. Burn that into your brain. And this is the step nobody can skip. The cap rate is not the return you actually pocket. It is the all-cash return on the property. The moment you add a loan, your real return is something different. And we call that cash on cash. Here is the magic and the danger of leverage. If your borrowing cost is below the cap rate, debt works for you, and your cash on cash return climbs above the cap. But if your borrowing cost is above the cap rate, debt works against you, and your actual return drops below it. That is called negative leverage, and in a higher rate market, it is everywhere. So never assume A 6 cap pays you 6%. It depends entirely on your financing. Let me show you how powerful this one number is. Take a property with $100,000 of net operating income. At a 6% cap rate, it is worth about $1.67 million. Now watch. Drop the cap to 5% and that exact same income is suddenly worth $2 million. Push the cap to 7% and it falls to roughly $1.43 million. Same building, same rent, hundreds of thousands of dollars in value, swinging on the cap rate alone. That is why this number runs the whole game. Let's put the two side by side, because confusing them is the costliest beginner mistake. On the left, the cap rate. It is unlevered, it ignores your loan, it is net operating income divided by price, and it is the same for every buyer looking at that deal. On the right, cash on cash. It is levered, it counts your loan, it is your cash flow divided by the cash you actually put in, and it changes with your financing. The cap rate prices the building. Cash on cash tells you what you personally earn. Here is the one to remember. If you pay all cash, your cash on cash equals the cap rate exactly. The second you borrow, they split apart. Now the mistake that catches new investors every time, chasing the highest cap rate on the page. A 9% cap looks incredible next to a 5, until you realize the market is not handing you free money. That extra yield is the market pricing in risk. Maybe the tenant's credit is weak. Maybe the lease has 2 years left. Maybe the building is functionally obsolete in a dying corridor. A high cap rate is not a deal. It is a question. Always ask, what risk am I being paid to take here? Answer that honestly, and you will never overpay for trouble again. Let's lock it in. A cap rate is your annual return if you paid all cash. The unlevered yield on the property. The two formulas. Cap rate equals NOI divided by price, and value equals NOI divided by the cap rate. What counts as good depends entirely on the asset class. Multifamily and industrial trade tight, office trades wide. Cap rates rise with interest rates and with risk, and remember, price always moves inverse to the cap rate. And the big one, the cap rate is not your actual return. Add leverage, and your cash on cash goes higher or lower depending on your financing. Nail these 5, and you can read any deal. If you are ready to put this to work, that is exactly what we do. I am Ryan Solberg with MaxLife Commercial. We help investors price, analyze, and close commercial deals across Central Florida and the entire state. See current cap rates by submarket and asset class, and run any deal through our free analyzer at maxlifedevelopment.com, or call us directly at 321-586-2121. Let's put a real number on your next investment. I will see you in the next one.